Hello, welcome to my channel. Today, I'd like to recommend a book on finance. The title is The Alchemy of Finance. The author is the most famous American financial master George Soros. This is the book is Soros's investment diary. We can appreciate the wonderful art of how Soros analyzes individual stocks, how he grasps the timing of market transformation, how he faces unfavorable market conditions and adjusts countermeasures in time, so as to be invincible in the changing financial market. If the investment world is compared to a jungle, then the two titans of the martial arts today are Warren Buffett and George Soros. Warren Buffett's investment performance naturally needs no elaboration, with a personal net worth of $89.6 billion in 2018, perennially hovering in the top 3 of the global rich list, under the Berkshire Hathaway stock performance in the United States Blue Chip Index, the top of the S&P 500. Unlike Warren Buffett, who focuses on traditional investment vehicles such as stocks and convertible bonds, Soros specializes in macro speculation, preferring to bet on a country's exchange rate or interest rates. Soros and his quantum fund became a household name in 1992 when he sniped the British pound, and in 1997 when the Asian financial crisis put his name on a blacklist of Asian central bankers. To learn about Warren Buffett, you need to read Berkshire Hathaway's annual letter to shareholders, which reviews the past year's investment performance of Buffett and Charlie Munger, detailing their latest views on the global economy and financial markets, as well as future investment trends. Warren Buffett's letter to shareholders is a must-read for every value investor every year. So what do you need to read to learn about Soros? Unfortunately, since Quantum Fund is not a public company, Soros does not have any obligation to present his investment philosophy and the latest knowledge of the market to the public. Therefore, we can only look through his old man's other works to get a glimpse of what is going on. This book, Financial Alchemy, is the only one of Soros' few publications that details his investment philosophy. In this book, Soros elaborates on his philosophy of antinomy, and describes how his quantum fund uses it to analyze financial markets and guide investments. At the end of the book, Soros makes his own policy recommendations on how to improve the financial markets based on the theory of transitivity. Unlike other financial bestsellers, this book is very difficult to understand. Rather than a financial book, it is a philosophy book that Soros gave to himself. If you know more about the old man, you will find that in Soros's self-identity, the positioning of the philosopher is far ahead of the investor. The focus of this book is actually to explain Soros' own philosophical theory of reflexivity. As for financial investment, it is just an application of Soros' own philosophical theory in this field of finance. This is a serious book, no less than a textbook, for students who are ambitious and overambitious. If you're ready, let's start reading together. My reading of the book will start with 3 main points. The first point: what is the theory of reflexivity? Second point: how did Soros and his quantum fund use the theory of contrarianism to guide their investments? The third point: what can we learn from Soros's investment review? Starting with the title, what is alchemy? Alchemy is a medieval European discipline of epiphany that studied how to extract gold from base metals such as copper and lead. Those of you who have taken junior high school chemistry classes know that even with today's technology, this is a pipe dream. The ever-serious Grandpa Soros is actually satirizing traditional financial theories, such as the perfect competitive market hypothesis, the theory of market equilibrium, and the hypothesis of perfectly rational man. These theories are like medieval alchemy, they are all fish in the woods. Using traditional financial theories to explain financial market phenomena, as well as to guide investments, can only be wrong again and again. A key assumption of traditional economics is that market participants have complete information and that under conditions of full competition, supply and demand reach equilibrium and form market prices. This theory assumes that equilibrium is the norm in the market and that the price formed in market equilibrium is determined by fundamentals. Prices may deviate from the fundamentals in the short term due to speculation in the market, but in the long term, prices will definitely return to the fundamentals. Soros believes that this seemingly complete economic theory is unbearable in reality. First, complete information, an important assumption in reality, does not exist. Second, since equilibrium is the market norm, then stable prices should also be the market norm, but what we actually see is constantly fluctuating market prices. Finally, traditional economics believes that the formation of prices is unilateral and determined by fundamentals, but the reality is that asset prices will have a supply and demand fundamental counteraction. As a result of this interaction, prices can deviate from fundamentals for long periods of time until an economic crisis occurs and a bubble bursts. The 2008 U.S. subprime mortgage crisis was a perfect example of Soros' argument. As early as 2005, it was already suggested that there was a bubble in the U.S. real estate market and that lending was too easy. However, distorted market prices backfired on fundamentals and the bubble continued to expand. Rising home prices stimulated the public to invest and enabled commercial banks to provide more loans with lower margins. At the same time, real estate investment, which also boosted other related industries, increased employment. The people were happy because they bought houses and made money. The banks were happy because their balance sheets were healthy and they kept making profits. And the government was happy because the economy kept growing and more property taxes were collected. With the efforts of many parties, prices continued to deviate from fundamentals and finally reached a critical mass, that is, when the disposable income of the people was not enough to pay the bank interest, and a once-in-a-century economic and financial crisis broke out. There may be a day when market prices return to fundamentals, but can you wait? If you are a fund manager, according to the traditional economic theory, you found the market price deviated from the fundamentals in 2005 and started to short the market, but due to the poor performance, you were out of job before 2008. If you have carefully observed the financial markets and have extensive investment experience, you will definitely agree with Soros. The so-called market equilibrium is actually anomalous, and the constantly fluctuating market prices are the norm. As for how to explain it, Soros proposes his own philosophical theory of transitivity. The theory of antinomy is the focus of this book and the core of Soros's philosophical theory. With the ambition of writing another book, The General Theory of Employment, Interest and Money, Soros borrows the common paradigm of natural science to organize the content of this book, first defining what transitivity theory is, then explaining transitivity theory specifically by explaining the context of the global debt crisis in 1982. In the third part, Soros uses transitivity theory as a guide to help you review. In the third part, Soros uses the theory of transitivity to help review and summarize the series of investment operations of the quantum fund in the late 1980s. In the last part of the book, Soros presents his views on the future economy and some of his opinions on global financial regulation. Although much of what is explored in this book is based on the financial markets of the 1980s, it is still a tremendous guide to how we understand international financial markets and the global economy today. First, the current U.S. government economic policies are the same as those of President Reagan in the 1980s: tax cuts, loose monetary policy, and increased infrastructure. At the same time, the hope is to reduce the fiscal deficit by stimulating the economy and raising revenues. More importantly, there is nothing new under the sun, and the right financial theory will apply to different financial cycles. After introducing the origin of this book, next, let's go back to the core of Soros' theory. What is antinomy? Simply put, the theory of transitivity is much like the Marxist philosophy of material consciousness, which refers to the fact that things themselves determine the perceptions of the participants, and the perceptions of the participants, in turn, have an impact on things. According to Soros, these two processes cannot be separated, are mutually causal and determine each other. The term reflexivity is actually taken from the French language. In French, if a verb has the same subject and object, the verb is called reflexive. The theory of reflexivity has a wide application. For example, in a normal stock market, the operation of a company affects the price of its stock, and in turn, the price of the stock affects the company's decisions. If the valuation is high, management may issue stock through high leverage to invest in mergers and acquisitions. If the valuation is low, management may buy back stock to boost investor confidence or reduce corporate risk by reducing debt in the expectation of increasing the company's valuation multiplier. Then again, in the international currency market, a country's currency exchange rate, in terms of fundamentals, is directly affected by foreign trade and international capital flows. International capital flows, in turn, can be divided into normal international investment lending and speculative capital flows, commonly known as hot money. International capital flows can deviate a country's exchange rate from its fundamentals for a considerable period of time. A distorted exchange rate, in turn, can have far-reaching effects on trade balances and capital flows. For example, Japan's 90s bubble, the international financial market confidence in the Japanese economy, a large number of bets on the yen continued to appreciate and deviated from the trade and interest rate fundamentals, the yen's sharp appreciation, so that Japan's trade imports and foreign investment rose sharply, the strong yen and the fundamentals continued to deviate. The burst of the real estate bubble into the last straw that broke the camel's back, the Japanese economy entered. The burst of the real estate bubble was the last straw that broke the camel's back, and the Japanese economy entered a 20-year sleep. The reflexivity theory also applies to the credit market, where the starting point of any credit crisis is usually stable economic growth. A growing economy boosts the cash flow and borrowing capacity of companies. With more debt, companies can expand their investments, expand their product lines, and increase their employment. At the same time, as the price of financial assets rises, the value of their collateral for borrowing also rises, giving them more room to borrow. The whole process is a self-feedback, self-reinforcing process. Until the average cost of debt continues to be greater than the growth rate of corporate profits, companies have a large-scale default, and the credit crisis officially arrives. The continued fermentation of the credit crisis is again a reverse self-reinforcing process. In the book, Soros sorts out the ins and outs of the international debt crisis that erupted in 1982 through 5 chapters, helping us to understand the theory of inverse self-reinforcement more deeply. It is important to note that Soros' philosophical theory of antinomy is not summarized through financial markets. Mr. Soros, as a professional philosopher and amateur investor, has always believed that the application of his philosophical theories goes far beyond the financial field, and that the financial market is merely a bullseye test of the antinomy theory. The cause of the 1982 global debt crisis can be traced back to the first global oil crisis in 1973. The major oil-producing countries in the Middle East imposed an oil embargo on the United States and other major Western countries, and the global price of crude oil soared, and the Middle East oil countries hoarded large amounts of European dollars. At that time, the operations of the world's major commercial banks were still tied up, due to the strict supervision of national regulators. Commercial banks in their own countries are not large. Many U.S. commercial banks, even interstate operations, are very difficult. As a result, the world's major banks have set up holding companies, through the establishment of subsidiaries in various developing countries, to expand international business. On the one hand, oil-producing countries, too much money to spend. On the other hand, national commercial banks are fully committed to expanding global business. So the two sides hit it off, and a large amount of petrodollars flowed into the accounts of the subsidiaries of international commercial banks. Due to the excessive liquidity, certain banks refused to accept new international deposits at one point during the height of the petrodollar flood. International banks with large deposits in hand lowered their lending standards, and large amounts of loans went to developing industrial countries. Because it was so easy to get loans from international commercial banks, major developing countries, especially Brazil, Chile, and Argentina in South America, once bypassed the IMF and the World Bank and sought loans directly from international commercial banks to cover their fiscal deficits. Some countries get the loans and invest in some infrastructure construction, and unreliable countries take cheap international loans and invest in building some bubble projects. Since international deposits are not regulated by the home country where the bank is located and do not require banks to set aside reserves, they are low cost and high yield for banks. International lending became an extra-legal part of the international financial system for a time in the late 1970s, and brought a seemingly constant stream of income to the major banks. At the same time, the Federal Reserve policy lagged with continued low interest rates and slow growth in inflation, resulting in continued lower real interest rates. Low interest rates at home, a flood of international dollars, a devaluation of the dollar, massive borrowing by developing countries, and continued growth in commodity prices. The various factors interacted, corroborated and reinforced each other, ultimately contributing to the international debt crisis of the early 1980s. What finally burst the bubble and changed the trend was the central bank's action to raise interest rates. Faced with repeated increases in their own inflation, central banks could no longer sit back and tighten monetary policy to curb inflation. But it was too late, the bubble was already too big to sustain. After the developed countries raised interest rates, the hard currency led by the dollar continued to appreciate and commodities depreciated. For the developing countries with high debt, on the one hand, the prices of export commodities fell, on the other hand, the appreciation of the dollar caused the growth of nominal debt. More commonly, it means that these developing countries, on the one hand, do not make money anymore, and on the other hand, they owe more money. Faced with years of accumulated debt, these countries have only one way to go: default. In the early 80s, Mexico, Brazil, Argentina, one after another outbreak of serious debt default. The whole process described above is a reflexive one, containing all the necessary elements of a common financial crisis. Firstly, the potential economic trend and the perceptions of the market actors are reflexive and influence each other. Secondly, in the process of reflexive formation, the perceptions of the market actors about the economic trend must have certain deviations. In the case that the deviations continue to develop continuously, the economic trend gradually develops to an unsustainable stage. Usually, economic growth is stable in the initial period of crisis development. Deviations become visible only when the trend is fully developed. When the bubble bursts, the previous trend, in turn, reverses and deepens itself, with ultimately catastrophic consequences. After introducing what the theory of transitivity is, let's talk about the second point. In the third part of the book, which is also the core of the book, Soros shows how his quantum fund used the theory of inversion to make a series of investment operations in the late 1980s. George Soros, who founded the quantum fund in 1969, maintained a staggering average annual investment return of more than 40% until 1987, when the book was first published, making the quantum fund one of the best in the hedge fund world. Soros describes himself as having three characteristics of quant funds: the use of leverage, investing in multiple financial markets simultaneously, and, most importantly, operating all of the fund's money as if it were his own capital. There were many funds that met one or two conditions, but very few hedge funds that met all three at the same time, at the time. In fact, to this day, there are most hedge funds that have a reputation for being good at PR and charging high management fees, but actually have mediocre investment performance. Regarding leverage, Soros believes that the best way to understand it is that leverage adds a dimension to a portfolio, making a mediocre portfolio three-dimensional. In a leveraged portfolio, the investment return on the principal portion of the portfolio must be sufficient to support the investment gains and losses on the borrowed funds portion. Many hedge funds make no distinction between the principal portion and the borrowed portion, investing together, but quantum funds clearly divides its financial investments into two parts. The borrowed funds are used to invest in riskier and more liquid futures, including stock indices, foreign exchange, bonds, and commodities. The principal is invested in relatively illiquid stocks, so that if the market moves dramatically and moves in the opposite direction of its own position, it does not need to short-term filling of large amounts of margin, will not be forced to liquidate. Quantum funds investment decisions are divided into macro and micro aspects. macroeconomic judgment, will determine the broad asset class allocation, micro judgment, will determine the selection of individual stocks and the choice of subdivision of investment categories. In this book, Soros focuses on the macro judgment of quantum funds. The investment review that Soros shares with you starts in the fall of 1985. Starting in August 1985, it took 5 months for the quantum fund to fully build up its portfolio, shifting from a flat U.S. stock market to a strongly bullish one, from a bearish U.S. bond market to a bullish Japanese bond market, consistently bullish on the Deutsche Mark and bearish on the U.S. dollar and oil, and adding a bullish open position in the Japanese yen. Initially, Soros believes that the U.S. economy will be a soft landing, the Fed continues to provide liquidity to the market, will reduce U.S. interest rates. On the other hand, inflation is gradually rising, which will cause real interest rates to continue to fall, resulting in the depreciation of the dollar. Bearish on the dollar, must be bullish on another currency. Soros initially chose the German mark, mainly because of the steady growth of the German economy, as well as the German mark has sufficient liquidity. Soros chose to take 2 positions in the German mark, mainly because the German central bank is expected to cut interest rates. The first position is after the establishment of investment views, the second is after the market fully digests the news of the German central bank to cut interest rates. As for the bearish oil, it was mainly based on the expectation of the expansion of production in the Middle East oil-producing countries. At the time, OPEC agreed internally on the share of oil output of each member country, so that the joint suppression of oil production, so that international oil prices remain high, so that each member country to obtain the maximum benefit, but OPEC members, except Saudi Arabia, has been in accordance with the agreement to reduce production. Almost all other members are in breach of production, in exchange for more benefits. Soros believes that Saudi Arabia, as the Middle East oil country with the largest reserves and lowest costs, will not sit still and will eventually expand production, and oil prices will fall sharply as a result. For the U.S. stock market, at first, Soros held a cautious view, mainly because the volume of M1 money rose sharply at the time, but the growth of M3 money volume stagnated. Soros believed that although there was sufficient liquidity in the market, consumer spending was likely to grow weakly and the economy would fall into what Keynes called a liquidity trap. The change in Soros' view came after a meeting of the 5 finance ministers. The meeting of the 5 finance ministers explored ways to reduce global trade protection. The U.S. Treasury also proposed a new bill to limit fiscal deficits. Soros believes that the new policy changes will bring a new engine of growth to the U.S. economy. The increase in exports from a weak dollar and the stimulus to the real economy from lower real interest rates will combine to make up for the shortfall in fiscal spending. Soros' new bullish exposure to Japanese government bonds is due to the Bank of Japan's sudden interest rate hike, which caused the yield curve on Japanese government bonds to invert. Soros believes that short-term interest rate rises will eventually return, and experience tells him that the best time to be bullish on long-term bonds is when the yield curve reverses. And, if the Fed continues to keep interest rates low, or even cut them, there is a boost to the global bond market. So, what can we learn from the above investment review? Other than Soros' discursive thinking of constantly questioning his views and using the theory of antinomy to look at markets dialectically and holistically. Other things that are instructive for the average investor include, first, don't take a full position at once. You may make less money by adding positions several times, but your risk is manageable, and even Soros cannot guarantee that he will get the best price at once. Also, don't be obsessed with your initial judgment. Do you want to make money, or do you want to prove yourself right? Finally, no matter how much economic data, how much gossip, what people say, the government, including the central bank, has the most profound impact on the economy and financial markets. Investors need to follow the policy, of course, to act quickly. Wait until all the policies are out, it is already too late. Back to Soros' investment review, what was the final result? In the first half of 1986, the Quantum Fund returned 126%. For comparison, Over the same period, the S&P index grew 27%, treasuries grew 30%, developed countries' currencies appreciated 23%, and the Japanese yen appreciated 34%. Admittedly, leverage has served to magnify returns, but leverage is a double-edged sword that, if used incorrectly, can lead to terrible losses. In the second half of 1986, the quant fund came back to earth with a 2% loss, while the S&P grew 2%, treasuries fell 2%, developed country currencies appreciated 10%, and the yen depreciated 2% over the same period. Soros was modest about the quantum fund's results, which left his peers in the dust, and felt his trading style was far from impeccable. He made a lot of money in the first half of the year due to his bullishness on the US and Japan, but was too late in liquidating his positions, resulting in giving back some of his profits. But in general, Soros believes that a good trading logic is not to make money in any market, but to make more money when the market is in your favor and to control losses when the market is against you. Another point worth learning is that Soros has never been paranoid about being bullish or bearish in his investments, and all his predictions are tentative and can change as the market changes. He even says that he makes money not because he predicts correctly, but because he keeps revising his wrong predictions. In the last part of the book, Soros, not surprisingly, once again launches an attack on traditional economic theory. He argues that the role of the market has never been to achieve the optimal allocation of resources. Rather than the tendency of markets to achieve equilibrium, the tendency of markets is always to achieve disequilibrium. When financial markets go to an unstable disequilibrium, perhaps the financial markets will correct themselves and return to the opposite direction, or central banks and governments will step in and correct the disequilibrium. If the correction is not possible, it usually means an economic crisis is coming. In more general terms, we usually think that prices will fluctuate up and down around value and eventually return to value. But, according to Soros, there is no such thing as a constant value. In most cases, prices will deviate from value from one extreme to another. When prices are at an unstable extreme, they will usually be corrected by the market or regulators, or a crisis will occur. All you have to do is keep following the trend, constantly judge whether the trend will reverse, and stop profit or stop loss at the right time, or even reverse it. We find that Soros' trading decisions are formed under this guiding idea, trying to predict the next wave of market trend, opening positions in time, while constantly interrogating yourself whether the current prediction is correct and whether the trend has reversed. If the initial prediction is correct, the portfolio will be profitable as the trend materializes while trying to close the position before the market reverses. If the initial prediction is wrong, it is important to reduce the position in time to control the risk. Well, that's all I have to say about my recommendation of this book. What I have described above is based on Financial Alchemy, which was first published by George Soros in 1987 and first introduced into China by Hainan Publishing House in 1999. In this book, Soros for the first and only time, and his investment philosophy, a complete review of the quantum fund's investment cycle. In line with the beginning of this recommendation, the two peaks of today's investment world are Warren Buffett and George Soros. These two investment masters, deep-seated investment philosophy, in fact, are in the same way. They both believe that the market is blind and most of the time will not reflect the true price of financial assets. Warren Buffett chose out of the world to establish a clear view of investment, long-term holdings, so that time to test everything. Soros chose to enter the world, soldiers will be blocked, water to cover, follow the ups and downs of the market, and constantly amend their short-term forecasts, fast in and out, and strive to earn profits in each wave of the trend. Well, this book is shared here. See you next time.